y'all, it's Mike Johnson with Fairway Independent Mortgage Company, and I thought I'd come to you today to kind of explain inside of the mortgage industry what's been going on with interest rates. And in order to do that, I'm going to take a big step back and kind of explain how healthy markets act. And then we'll introduce fear into the market, which is basically, today it's COVID-19, it's coronavirus. And then I'll get a little more specific, micro look at mortgage rates and what's going on with them. And then in the end, I'll give you my best advice on what you should do going forward. So let's hop into the stock market, the bond market, and the overall market to talk about how healthy markets should act in times of no duress. So in healthy markets, we have a universe of investors. This is you, me, stock funds, 401ks being invested into stocks and bonds. Bonds are seen as safe and secure. This is where corporations and governments go to get their money. And in order to get their money, they offer a specific rate of return. In the stock market, not so. There's no guaranteed returns. You can lose everything, or you can make a lot of money if you invest in the right companies. By your weighting, by the amount you put in each, that's your portfolio. And in a normal, functioning, healthy environment, your funds will grow over time. Now, this is a healthy market, right? Investors deciding how much to put in bonds, how much to put in stocks. Now, what happens when fear comes in, when something like COVID-19 happens and we get a lot of uncertainty? So first of all, let's talk about how do you measure fear in the markets. And it's really easy because we have what's known as the volatility index. So the volatility index, known as the VIX, measures fear in the market. And normal functioning markets sit generally between 10 and 25 on the VIX. And basically, as you see, they go up, down, up, down. These red spikes, these are just times when we have a little bit of market uncertainty. This can be a couple of companies missing their earnings. This can be a company going bankrupt. So that might cause some fear in the market, but generally not so much that it's going to, upset the natural balance between the markets. However, when you get something like 9/11, a housing crisis, or our little friend here, COVID-19, suddenly massive financial uncertainty enters the market, right? We start seeing things that we haven't experienced before. We don't know exactly how this is going to end. We don't know exactly how to even treat yet. That causes investors to, make some decisions. So let's track this through. We now have fear in the market because of COVID-19, right? So with that fear, let's try to do it in orange. With that fear, we get COVID-19. We now have financial market uncertainty, right? We have lots of hotel, restaurant workers being laid off. That makes their future finances uncertain. That kind of snowballs into other areas, and now restaurants only have drive-through and yada, yada, yada. You get it. So basically what we have is we have financial market uncertainty, which causes a spike in the VIX. Anytime between 25 and 80 on the VIX, as you start accelerating up, you get massive selling. Normally 25 to 35 to 40, this causes what's known as a flight to quality. So what is a flight to quality? Well, say around 40, between 25 and 40 in an extended bull market. Investors might be thinking, hey, I've made a lot of money over here, but I see risk increasing. So I'm going to jump on over here for a little while to the bond market, and I'm going to make some guaranteed returns over a period of time, even though if this stock market gets better and it starts going up again, I might make a lot of money. So basically, too much risk. I'm going to jump on over, take a flight to quality, to something that's more safe and secure. I'm willing to take a little less money, and I'm willing to lock up my money for a period of time in order to be safe and secure. That's a normal flight to security, right? Flight to quality. Now, when it gets to a point where we start getting, if this is 40, minor spikes, you start getting above 40 to 80, something else happens here. We start getting mass layoffs. We start getting corporations not able to make their earnings numbers because people tend to hold their money in times of uncertainty, so they're not out buying. Our economy slows. So instead, this flight to quality can switch. There's only one other flight to quality, The one thing you can do, and investors will do, is they're going to put their money away and they're going to lock it up, right? I don't know why these circles equal locking it up, but let's just say. So investors, people like you and me, 401ks, they're gonna move to the sidelines, right? No money. I don't know if I have the green one still. No money left. Okay, awkward moment. No money left for stocks. No money left for bonds. This happened during the housing crisis, and if you're old enough, you remember exactly what happened. You couldn't buy a car, you couldn't give houses away, you couldn't get financing. The financial markets absolutely locked up. We needed stimulus, we needed Fed action. So now, stocks, bonds, no money's coming into either, and investors are sitting on their money, right? We've seen the stock market go down 35%. We've seen bonds, and we're going to talk a second about bond yields. We've seen bonds start to get priced in ways that aren't natural. When we get that, let's come back here. When we get markets that seize up, when investors have no interest in going to either, we need Federal Reserve action. And we've gotten it. So the Federal Reserve took short-term interest rates to zero. Now, let's talk about what that means. So what they're trying to do is they're trying to entice investors to come back into the markets. When we take this money to zero, when we take the short-term interest rates to zero, it helps credit card rates, car financing, and things like that. The second thing the Fed did is they came in and they just basically said, now this is specific for mortgage. I don't know if we can get down into this lower corner, but if you can see these, the Fed pumped in a massive amount. They said they would do $4 trillion. They also said something about the MBS market, the mortgage-backed securities market. They said they would buy, and buy. Why are they doing that, right? So they're buying because, and now if I can introduce you to the thing that I just about knocked over, what they're doing is they're buying in the mortgage-backed securities because of this little guy right here. Hopefully you can see that. That spike. Let me explain this chart real quick. Okay, this deals with what's called yield spread. Yield spread can be defined as the 30-year mortgage over the 10-year treasury. What's the difference? That's going to be the yield spread. So when you compare these two, what's the math? Okay, truth be told, I did not like this when I watched the video back. It's too small, can't be seen. So give me a second, I'm going to just sort of recreate it up here and then we'll get right back to it. Okay, so I was probably going to make that way too confusing. I think I can get this yield spread explanation done pretty simply. So it's basically, we have the 10-year and we have a 30-year mortgage. And this is a treasury. Right now, the important thing to know is that treasuries are around 1, mortgages are around 4. We have a 3% yield. That is historically very high. So the last time, as an example, that we had this high of a yield spread was during the housing crisis at 3.27. Remember, this time of our history, we couldn't get car financing, we couldn't sell our homes, couldn't give our homes away. The markets had completely locked up. The Fed had to come in with quantitative easing. The government had to give a massive stimulus plan. We don't have to think about what they're going to do because they're doing the same thing today. They're just trying to get enough money out there to kind of, start the heart again, pump us back up, get us going in our economy. We already know the numbers are going to be brutally ugly. So as far as this is concerned, in order for this gap to come down, it could go one of two ways, right? This yield spread can be healthy, at 2%, economies can rock and roll in here at 2%. Well, if we have a 4% mortgage, what if the 10-year moves up to 2%? 4 minus 2 equals 2%. That can happen too. Generally, that'd be a healthier economy, but the point is, to close that yield spread, we can go either direction. Do we have a preferred way for that to happen? Do we have a preferred solution to this? Of course we do. If we're at 4% on interest rates, on mortgage interest rates, down here at 3%, I don't know the exact figure. There's no less than $1 trillion available to Americans if they refi, right? $1 trillion up here. Up here, not so much. Down here, there's savings of $200, $300, and $400 a month in people's current mortgages. So that in these uncertain times is super important. So we're all hoping that the yield spread narrows by having the mortgages come down to the 10-year, come back down that direction. And of course, that's what we're all hoping. So if that happens, what does that mean for you? If you're in that group of people who have current mortgages above 4%, and getting a savings of $200, $300, or $400 would be important to your family, and I don't know what family wouldn't benefit from $200, $300, or $400 extra every month. If you're in that group of people, what should you do? So what I'm advising customers to do is to give a call to a loan officer and have a conversation where you can design the following plan. You're going to pick a loan product. You're going to pick an interest rate that yields the savings you're hoping to find. And that's just math. It's not that hard to figure out. Let's say in order to save $300 a month, you need a 3.25 interest rate. Well, when that rate comes, if you're pre-qualified and pre-approved with a loan officer, they can grab that rate for you and lock it in. We're going to lock it in over 60 to 75 days. Now, the reason we're going to lock that in for a long period of time, there's two reasons. One, when these rates go low, it's going to get super busy. 2 weeks ago when it got super busy, there were so many loans at the top of the gumball machine that the bottom of the gumball machine was literally spitting out, one at a time. These are loan closes, but up here, these are all the people wanting to close a loan. In the middle are the professionals who make the loan industry work: processors, underwriters, appraisers, title and escrow, and those people were working their tails off, 16-hour days, 18-hour days. The system itself probably can't handle massive amounts of refinancing, like historic amounts of refinancing, and that's what started to happen. So I'm going to lock you in for 60 to 75 days because that rate is the super important part. During that time frame, you're not going to apply for new credit, you're not going to go out spending crazy, and you're going to need to save, or if you haven't already, saved the cash to close the loan if we're not financing it into the loan. You get fully pre-approved with your lender, and you pick an interest rate that will work for that. If you do better, great, but it's not a time to gamble. It's really not. Right now, it's a time to lock in the savings that you need. That's my advice, and I appreciate you for listening. We're all kind of sheltering in place, trying to figure out what to do during our days at home. And thanks for letting me come into your house and listening to me, and hopefully this has given you some good information. Again, I'm Mike Johnson with Fairway Independent Mortgage Company, and thanks for listening. Have a great day.